Good afternoon, my dear friends. Myself, Dr. N. Sengupta, once again would like to welcome you all in this particular session of intermediate level, uh, which is paper 8A of financial management. As you know, that it is having two area. One is 8A and one is 8B. So this 8A is financial management that has been discussed today. So we are having a few of the areas which we'd like to discuss. And obviously, if you have any queries, you can always ask for those queries. What are the things we are going to discuss? We are going to discuss the syllabus and section-wise weightage and then skill-wise weightage. What is the structure of question paper? Summary of each chapter with important points to remember. That also we'll try to discuss in this particular session, and then how you can revise this particular session, and from examination point of view, various do's and don'ts. First, let us talk about the syllabus and section wise weightage. Okay. Introduction to financial management function, the financial management and financial analysis part. So introduction part is going to be there. And then there is going to be the financial analysis through ratio. And there are various questions of ratio in this particular section. So these two part will be included in the very first part, which consists of 10 to 15% of weightage, that is of 7 to 10 marks. Now the second part, which is a very significant part of this particular syllabus, that is of financing decision, sources of finance, cost of capital and capital structure decision, and leverage, which is of 29 to 33 marks. So this 29 to 33 marks, that is going to come from sources of finance, cost of capital, capital structure decision, and leverage. And then the third part, another significant part, where there are three units basically. One is the capital budgeting, capital investment decision, then adjustment of risk and uncertainty, and then there is dividend decision. 30 to 35% weightage is given to this, and 22 to 25 marks is basically the weightage. Then management of working capital, which is of 10 to 15%, that is 8 to 10 marks. That 8 to 10 marks management of working capital is going to be of various units, the inventory, the receivables, the creditors, cash management, everything is going to be the part of this working capital management. So that is going to be of 10 to 15%, that is of 8 to 10 marks. Then skill-wise weightage, if you see skill-wise weightage, level 1, which is of knowledge and comprehension, the skill-wise weightage is 20 to 30%. And level 2, application and analysis, that is of 70 to 80%. That is the numerical questions. So theoretical question is of 20% to 30%, and application analysis part is 70 to 80%. Compulsory question consisting of 4 numericals of 5 marks each. So there are 4 numericals of 5 marks, 20 marks will be there. Then second to 5 questions, second, third, fourth, and fifth question, which can consist of both numerical and theoretical question. That is of 10 into 4. So there will be 4 questions. There may be sub question also of 40 marks. And then the last question with an internal choice of 2 marks. So total marks of the question paper will be 72, including a general choice of 10 marks. So now chapter wise, let us discuss about some of the summary, some of the very brief point, and after that, we'll take up some questions, and if required, some questions from the MTP. If you have any issue in any of the questions of MTP, that also can be discussed. Okay. Yes, Mr. Arun, do you have any query? Yes, you can post your query. There is no issue, and we'll try to immediately resolve your queries. So in the scope and objective of financial management, there are different important concepts. First of all, when we talk about the long-term finance decision, there are three kind of decisions like investment decision, financing decision, and dividend decision. Profit maximization vis-a-vis the wealth maximization. Then the short-term finance, that is working capital management. Role and functions of CFO, that is Chief Financial Officer. Scope and objective of financial management. Relationship of financial management with other disciplines. So this is the first unit what we need to study. Then type of financing, the financial sources based on maturity of repayment, long term, medium term, and short term, based on basic sources, that is external and internal. In case of external sources, there can be share capital, and share capital further can be divided um, into equity share and preference share. And debt and borrowed capital can be categorized as debenture, loan from financial institutions, and others. And internal sources may be mainly the retained earning. As far as the various sources of finance is concerned, there are long-term sources of share capital, preference share, retained earning, debenture, loan from financial institutions, loan from SFCs, loan from the commercial banks, venture capital, asset securitization. So these are the long-term sources. Then in the mid-term, preference, debenture oblique bonds, public deposit, medium-term loans, lease financing, external commercial borrowing, euro issue, a foreign currency bond, etc. Then short-term, trade credit, accrued expenses and deferred income, short-term loan, fixed deposit, advance receipt from customer, various short-term provisions. Some important sources of finance, some definition you can go through. Masala bond, for an example. Masala generally means spice. So that is the bond is an Indian name of which is used in rupee denominated bond of Indian corporates. NTPC, for an example, one of the organizations which issued this kind of bond. Then different definitions like venture capital, then bridge financing, lease financing, all these concepts should be very, very clear to you. Now, in the third category, there are various kind of ratios. What are the type of ratios we have? We have liquidity ratio, we have short-term solvency ratio, we have activity ratio, which is also known as efficiency ratio or performance ratio or turnover ratio, and then profitability ratio. Leverage ratios is divided into two parts. One is capital structure ratio and coverage ratio. Profitability ratios is related to four parts, related to sales, related to overall return, required for analysis from owner's point of view. So this is basically from equity shareholders point of view, from equity holders point of view. Then there are different market valuation or investor related ratios as well. So now these are different kind of ratios, a summary which is taken from the study material itself. Yes, Sia has asked that, sir, in chapter 2, which type of question come from international sources? They can mention different kind of international sources, and they can ask you to explain that. For an example, external commercial borrowing or ADR, JDR. So those kind of questions, or what are the internal sources? Some of the definition may ask, some of the concept they may ask, but generally theoretical question comes from this particular part. Is it clear, Sia? Okay. So as I was telling you, so these are different kind of liquidity ratio. Among the liquidity ratio, current ratio and quick ratio, are the two major ratios which is available. Then coverage ratio, debt service coverage ratio, interest coverage ratio, preference dividend ratio, fixed charge coverage ratio, earnings available for debt services divided by interest plus installment. This is a very important ratio for credit appraisal also of which is issued by, which is done by different financial institution for banks. Yes, yeah, thank you very much. If other student is having any other query, you kindly don't hesitate to ask. We'll try to reply your query as well. Then interest coverage ratio, EBIT by interest, preference dividend coverage ratio, net profit by preference dividend liability, fixed charges coverage ratio, EBIT plus depreciation divided by interest plus repayment of loan, equity ratio, shareholders equity by net asset, debt ratio, which is the total asset divided by net asset, debt to equity. It can be outside liability, it can be only the liabilities, which is the total outside liabilities. So it can be categorized in different ways. Capital gearing, another very important ratio. Preference share, debenture plus any other borrowed fund where you have to pay your money divided by your equity share capital plus reserve and surplus minus losses, and then a proprietary fund by total asset, which is proprietary ratio. Then profitability ratio related to overall return on asset. So return on investment is return by investment into 100. Return on asset is net profit after tax by average total assets. Uh, Return on capital employed is ROCE. Capital EBIT by capital employed into 100. Return on capital employed or ROCE post tax, that is EBIT into 1 minus T by capital employed, and then ROE. So return on investment can be calculated on different bases. It can be return on asset, it can be return on capital employed, it can be return on capital employed pre-tax as well as post-tax, and then return on equity. Then gross profit ratio, net profit ratio, operating profit ratio. So these are the some of the other ratios which is based on the sales. Then activity ratios, either you can take sales and cost of goods sold. A lot of students ask questions, sir, when to take sales and when to take cost of goods sold. The basic difference of taking sales and cost of goods sold is that when we take sales, basically we are considering the profit element into consideration as well. But when we are taking cost of goods sold, we are not taking the profit. That means we are only considering the cost part of it. So that's basically, so cost of, when you are taking the cost part, it means that profit element has been removed from that, or the effect of that is not been taken. So that's why in a lot of places you can see sales oblique cost of goods sold. And when you are calculating inventory, when you are calculating those kind of things, is always better to take the cost of goods sold, but always there is an option. For an example, receivable turnover ratio or receivable velocity, you can take credit sale by average accounts receivable, and payables turnover ratio, the annual credit purchase divided by the average accounts payable. So that's from the activity perspective or efficiency perspective, these are the ratios. Now let's talk about earning per share. Earning per share is net profit available to equity shareholders and divided by the number of equity shares outstanding. Then dividend per share is dividend paid to equity shareholders divided by number of equity shares outstanding. Dividend payout ratio is uh, dividend which is issued per equity share divided by earning per share. So that is DPS by EPS. Price earning ratio is MP, that is market price by EPS. Dividend yield, that is dividend changes in share price by installment by the initial share price, which is known as P0, earning yield, that is EPS by MPS, market value by book value per share is market value per share divided by book value per share, and Q ratio is market value of equity and liabilities and divided by the replacement cost of that particular asset. Q asset is also very important. What are the important points to remember in this particular chapter? Preparation of balance sheet, which is generally the type of question we see very often in the question paper. Then determination of different kind of ratio, the calculation of different ratios when other ratios are given, determining different ratios when balance sheet and income statement is given. So let's discuss one question or any question from this. We'll discuss one question of ratio analysis. Any question if you have, you can let me know. I can see a lot of students are there. So Uday, Arun, if you have any query related to the ratio analysis, how to approach CR, you can always ask so that we can go to the next part of the how to solve the question of ratio analysis. Any query? So that we can go to the next part as well. Okay, okay. Shall we discuss the question then? Fine. So now let us discuss the question, that is SN Limited has furnished the following ratios and information related to the year ended 31st March. Share capital 6,25,000, working capital is 2 lakh, gross margin is 25%, inventory turnover is 5 times, average collection period is 1.5 months, current ratio is 1.5:1, quick ratio is 0.7:1, reserve and surplus to bank and cash 3 times. Further, the asset of the company consists of fixed asset and current asset, while its current liability comprising bank credit and others in the ratio of 3:1. And we assume that 360 days in a year, and we need to prepare a balance sheet. So now let's see how we can prepare this particular balance sheet. The current ratio, you can see the current ratio which is given here. You can see that current ratio is 1.5:1. Yeah. You can see this is the current ratio, and then the quick ratio is also given. So by applying this, we can find out certain things. Working capital is also given. The working capital means CA minus CL, current asset minus current liability, right? So we have started with the current ratio. Current ratio means the current asset divided by current liability, that is 1.5 divided by 1. Current asset is equals to 1.5 current liability. Also, current asset minus current liability is 2 lakh. So 1.5 current liability minus current liability is 2 lakh. So current liability is 4 lakh and current asset is going to be 6 lakh. Then second, bank credit to other current liabilities, that is 3:1. Bank credit divided by other current liabilities, that is 3/1. So bank credit is equal to 3 other current liabilities. Also, bank credit plus the other current liabilities is equal to current liabilities. So in this way, we can find out what is the bank credit. So this ratio is also given. You can see this particular ratio 3 times. Right? RNS is also there. So that also we will be using. Quick ratio is given. So from quick ratio, because since we are deducting the inventory, we can find the inventory. From inventory turnover ratio, we can find the cost of goods sold. And by applying the gross profit, we can also calculate the sales. So in this way, with the help of one ratio with another, we can find out the figures. Similarly, average collection period, if you want to calculate, then receivables we can calculate 2,66,667. Bank and cash is going to be the total current asset minus already we have calculated debtors or receivables plus inventory, that is 13,333. Reserve and surplus is going to be equals to 40,000. So in this way, we'll be able to calculate, find out the balance sheet. Share capital, reserve and surplus, current liabilities, bank credit and other liabilities, fixed asset, current asset, inventory, debtors, and bank and cash. Then in case of cost of capital, so let us discuss the cost of capital. What are the major areas of cost of capital from where we see the questions? Mainly weighted average cost of capital. And there are two techniques we apply in weighted average cost of capital. One is book value weights, another is the market value weights. So we can calculate the question both on weighted average, both on book value as well as market value. Even in some of the question you have seen in the study material that you need to apply the book value as well as the market value. So combination of cost and weight of each resources. So weighted average cost of capital is percentage of debt into cost of debt, percentage of preference capital into cost of preference, percentage of equity into cost of equity, and then marginal cost of capital, cost of raising an additional rupee of capital. As far as the cost of sources of capital is concerned, debt can be calculated before tax and after tax, and debt can be also irredeemable and redeemable. So accordingly, it has been discussed in the study material as well. Cost of preference share capital, it can be redeemable as well as irredeemable, and accordingly you can calculate that. Cost of equity, there are various techniques which you can apply in cost of equity. Dividend price approach, then earning price approach. Dividend price approach is dividend by P0. Earning price approach is earning by market price. Growth approach is D1 by P0 plus G when there is a growth of the dividend, maybe 2%, 3% or 5%. Then a realized yield approach that first records of dividend, CAPM, that is cost of equity is equal to risk-free plus beta into RM minus RF. Cost of retained earning is going to be cost of equity into 1 minus the personal tax. What are the important points you should remember? Mind you, mainly there are questions of weighted average cost of capital and marginal cost of capital sometimes. This time also we have given one question of marginal cost of capital, that is known as MACC. So calculation of individual sources, debenture, preference and equity you need to know. Then calculation of weighted average cost of capital you need to know. Determination of revised weighted average cost of capital you need to know. Calculation of marginal cost of capital, as I told you, MACC, that also you need to know. Determination of existing and new weighted average cost of capital also you need to calculate. Then let's go to the next chapter, which is chapter number 5, a very important chapter, capital structure. Any question, by the way, if you have, you can always send it to us. Now, if you see, there are various approach in capital structure. There are mainly 4 approach: NI approach, traditional approach, NOI approach, and Modigliani and Miller approach, and financial hierarchy. And then designing an optimal capital structure, that is the trade-off between EBIT and EPS relationship. In case of approach, it is with tax and without tax. In case of financial hierarchy, trade-off theory and pecking order theory. So very briefly, let me tell it to you. The relevance theories are three. You can see there are three relevance theory: NI, traditional approach, and Modigliani approach. And irrelevance theory, NOI approach, and then Modigliani-Miller approach. So in case of approach, Modigliani and Miller approach, there is with tax also and without tax also. Without tax, it becomes irrelevance. Okay. So these are different concepts. This is very important. You please note it down. How to calculate the levered form and unlevered form cost, and how to calculate without tax, how to calculate with tax, right? And then there is a very important concept of EBIT EPS relationship. So EBIT EPS relationship is EBIT minus I1 into 1 minus T divided by E1 is equal to EBIT minus I2 into 1 minus T then divided by E2. So at what point, at what EBIT, the EPS is going to be the same? That is basically known as EBIT EPS relationship. Then different questions asked on various approaches. Question based on levered and unlevered firm. So determining the better financial plan, calculation of indifferent point and EPS, determination of current and revised capital structure, questions where debt is increased and interest percentage is changes. So these are the different kind of questions which is asked from this particular chapter. Now let's talk about the leverage. Very conceptual paper, conceptual topic in fact. So there are three kind of leverage. One is operating leverage, one is financial leverage, and another is combined leverage. So in case of operating leverage, it is basically the ratio of contribution by EBIT. In case of financial leverage, it is the ratio of what kind of interest we are paying into that. So EBIT by EBT, and combination of these two, if you see degree of operating leverage and degree of financial leverage, then it will be known as degree of combined leverage. And any changes in EBIT, any changes in sales, how it is going to affect the EBIT or vice versa, is going to be represented by degree of operating leverage. Any changes in EBIT, how it is going to impact the EPS is going to be determined by the degree of financial leverage. And sales to EPS, the whole picture, whole what I will say area will be determined by the degree of combined leverage. So operating leverage, financial leverage, and combined leverage. Now you can see how we can calculate it. Operating leverage is contribution by EBIT. Or if you talk about the degree, or if you want to make the changes that how it is going to impact other, it is the percentage change in EBIT divided by percentage change in sales. Degree of financial leverage, percentage change in EPS divided by percentage change in EBIT. Combined leverage is equal to contribution by EBT, degree of combined leverage, percentage change in EPS divided by percentage change in sales. So this is the way basically the leverage calculation will be done. There are two very important concepts in case of financial leverage. One is known as that how it is known as trading on equity. Another is it is known as double-edged sword. So trading on equity, it basically says that when financial leverage, you are using more and more debt fund. That means your equity share capital has gone down. So you are too much dependent on basically long-term debts. And based on that, if your situation is good, that means if you are having a lot of profit, if your return is good, then this situation will give maximum return to the equity shareholders. Okay, so that is known as trading on equity. It's a small percentage of equity and balance you can depend on debt. Double edged sword, it can be advantage, it can be disadvantage also. For an example, if your return on investment is more than the cost of debt, let's say if it is return on investment is 25% and debt is 15%, so there is a 10% surplus which goes to the equity shareholders, which will help to increase the EPS. And it's just opposite in case of when your ROI is less than the cost of debt. When your ROI is less than the cost of debt, ROI is 10% and cost of debt is 15%. That means 5% deficit to be borne by the equity shareholders, that is EPS. What are the important points? Question based on calculation of different leverage, determination of percentage change in figure, theoretical question on leverage, calculation of leverage when balance sheet is given, preparation of income statement when any leverage value is given. Let's discuss any query you have. You just let me know. As once again, yes, Sia, do you have any query? Okay, fine. Yes, we'll try to take some questions of mock test paper. Right. Any doubt you have in any mock test paper? Okay. So from the following information, let's prepare an income statement of company A and B. Margin of safety is 0.20 and 0.25. So from margin of safety, this very interesting question. Interest is given, PV ratio is given, financial leverage is given, and tax rate is 45% and 45%. So company A, financial leverage, if you want to calculate, it will be 4,000, and company B, if you calculate the financial leverage based on the ratio, it will be 3,000. Then operating leverage, with the help of operating leverage, we can find the contribution also. Contribution will be 20,000 divided by 20,000, and in case of B, it will be 12,000. So if you see the total income statement of the company, sales less variable cost less, then the contribution will get. So this is the contribution. Then less fixed cost, that is your EBIT. Then less interest, that is 3,000 and 2,000. Then EBT is 1,000 and 1,000. Tax is 450 and 450. So that comes 550 and 550, right? So this is the income statement we can get, and PV ratio, which is given as 25%. So based on that, we can calculate the sales of both the company, and accordingly we can prepare the income statement. So very interesting question. Then investment decision, basically you need to find out that different kind of statement which shows the calculation of cash inflow after tax, that is CFAT, and total sales unit, sale price is given, and cash flow after tax is also given. So based on that particular thing, we need to find out the statement of the cash flow. So when this all figures are given, you can calculate the cash flow after tax, and then you can apply different technique. There are mainly 5 technique, as you know. The first technique is payback. Then the second technique is accounting rate of return. Then the third technique is NPV, that is the net present value. Then desirability factor or profitability index. Then IRR, internal rate of return, modified internal rate of return, discounted payback, that is PV of cash flows and PV flows. Important points to remember: theoretical question based on the capital budgeting technique, whether a project should be accepted or not using the NPV and other techniques. Can you hear me? Okay. So after that, let's go to the next part. This is a question of capital budgeting, simple question, just to explain you different technique. So you can apply the payback, you can apply the NPV, you can find out the NPV, PI, internal rate of return with 10% and 15%, and table is also given. So calculation of payback period, that can be done. Then cash outlay of the project, then total cash outlay for the first 5 years, and inflow for the 6th year. So the payback period is going to be between the 5th and 6th, and accordingly we have calculated. So in 5 year, whatever we have got, we need to achieve more of 10,000, but in the last year it is 16,000. So 5.6 to 5 years, or 5 year and 7.5 months. In this way, if we talk about the present value, and if we add, be total present value will be 97,92,200. And if from that we reduce the outflow, this you can reduce from here. So your inflow will be, NPV will be 7,92,000. And calculation of profitability index at a rate of discount, 10% discount rate, is going to be 1.224. Calculation of internal rate of return, we have taken 10% and 15%. And mind you, when you will be talking about the internal rate of return, in one rate it has to be positive, and another rate it has to be negative. So your internal return is going to be the midway of the rate. That means if you are taking 10% and 15%, so your internal rate of return is going to be between 10% and 15%. At present, NPV is a 15% discount rate, which is negative, and internal rate so falls between 10 and 15%. Then you can apply this particular formula, that lower rate plus the NPV of the lower rate, and NPV of the lower rate minus higher rate into the rate of difference. So we have taken 15 and 10. So that 15 and 10 we have taken here. So in this way, if you found that our internal rate of return is 14.7%. What is the meaning of internal rate of return? Internal rate of return basically means the rate at which our inflow is equals to the outflow. So it basically indicates the rate at which the inflow is equals to outflow. Then the risk analysis in capital budgeting, there is statistical technique, conventional technique, and other technique. In case of statistical technique, there is probability, variance, standard deviation, coefficient of variance. Then in case of conventional technique, risk adjusted, certainty equivalence and sensitive analysis and scenario analysis. In case of probability, expected net cash flow, expected cash net flow. Yes, we'll be discussing some questions of mock test paper. Yes, after one or two more chapters, and then we'll take some questions, right? Okay. Then standard deviation, then coefficient of variation, then RADR, CE, that is certainty equivalence, sensitivity analysis, scenario analysis. All these things you should go through. There are various things you should remember here. The calculation of expected cash flow, standard deviation, the variance and coefficient of variance, question based on risk adjusted discounting rate, that is RADR, question based on CE approach, use of sensitivity and scenario analysis to calculate the NPV. So this is one question. A lot of time we have seen that this type of questions, in fact, it was there in the last term paper also. Project X, there is probability 0.30, 0.30 and 0.40. Project Y probability is 0.20, 0.30 and 0.50. So how we can calculate the expected net cash flow of each project, then variance, standard deviation and coefficient of variance. Very simple. How we calculate the expected net cash flow? So these are the cash flows which is given. Then these are the probabilities. So if you multiply the cash flows into probabilities, it was expected net cash flow. Then 60,000 into 0.30, it is 18,000. 70,000 into 0.40 is 28,000. Net cash flow is 1,30,000 into 0.20 is 26,000. 1,10,000 into 0.30 is 33,000. 90,000 into 0.50 is 45,000. So it is 1,04,000. So this is 1,04,000 and this is 61,000. Now, how will we be calculating the variance? From here, we need to find the variance of each. So 61,000 minus 50,000 into the probability, square into probability. 61,000 minus 60,000 square into probability. 61,000 minus 70,000 square into probability. Similarly, if you do that, then we'll be getting the variance of the first project, and same way we can find the variance of the second project. So first we have calculated the expected net cash flow. Second, we have calculated the variance. Third is the standard deviation. In case of standard deviation, variance will be taking and then root over the variance. That will be 8,306, and here 8,000 24 lakh 40,000, 24 crores 40 lakh. So if you take the root of that, that is 15,620. Now coefficient of variance, if you want to calculate, then it will be SD divided by the expected net cash flow. So in the first project, it is 13.60, and in the second project, it is 15. So you can see that in the project X, risk is less, expected net cash flow is also less. And in case of project Y, the risk is more, but expected net cash flow is also more. So project is less risky, but project Y is more risky, but expected net cash flow also is more in case of project Y. Then the next topic is dividend decision. So in case of dividend decision, irrelevance theory and relevance theory. So approach, Walter approach, and Gordon model, then dividend discount model, Graham-Dodd model, and Linter model. So all these models you need to remember, and generally we have seen that there is a numerical question which comes from any of these particular models. So all these models should be known to you. I have made a summary for you people that if you talk about Modigliani and Miller, how it should be done. If you talk about Walter's model, how it should be done. If you talk about Gordon's model, how it should be done. If you talk about dividend discount model, how it should be done. And zero growth, constant growth, and variable growth. So in this way, basically, it will be done. Graham and Dodd model, which is not a very popular model, then Linter model. So these are the different models which is there. Effect of dividend on market value of share, then question based on P ratio we see, then calculation of market price based on different approach. It may be based on Walter approach, Gordon approach, then approach, and then calculation of market price here by using the dividend payout ratio or DP ratio. So this is one question we can take on we can very quickly go through this particular question. First, total earning is given. A lot of time we have seen this kind of question. Total earning is given, that is of 2 lakh. Number of equity share is 20,000. Dividend paid is 1,50,000. Price earning ratio is 12.5. Applying the model, we have to analyze whether the company is following an optimal dividend policy. And we have to compute the P ratio at which the dividend policy will have no effect on the value of the share. We have to also find out that whether our decision changes in if the P ratio is 8 instead of 12.5. So price, you can see that price in first case, we have calculated all these things are known to you. So this is 132.81. And the second situation, it is 156.25. Optimal dividend ratio in this situation will be when zero dividend is paid. So when zero dividend is paid, you can see that the market price is the highest. Then PE ratio at which dividend policy will have no effect on the value of share. Very interesting question, where KE would be equal to the rate of the return. So KE and R will be equal. So if KE, let's say, is 10% and PE is 10%, so therefore P ratio will be 10. The dividend policy will not have any effect on the value of share. And if the P is 8 instead of 12.5, where we have taken 12.5, if it is 8, which is inverse of the P ratio, would be 12.5. In that particular situation, the cost of equity will be more than the return. And as per Walter's model, it will be 76. So price is going to be 76. And very briefly, let us touch the working capital part. In this, there is introduction, the treasury management, the management of inventory, management of receivable, management of payables, financing of working capital. So calculation of operating cycle is one type of question. Then there is a question on the proposed policy, how the proposed policy should be done. Then different points, basically the questions, operating cycle, then working capital, preparation of the cash budget, credit terms as well as appraisal of credit policy is very important. And then the theoretical question is also there. How to revise this particular subject? You can use the BoS references for quick revision, which is generally we keep on the in the module. It is also hosted on the BoS knowledge portal. For some of the subject, it is there as a publication. Go for quick and short notes for the theoretical part. Highlight or bold portions in the modules. Then compilation of formulas in all chapters at one place and revise from it. Refer to the points and mistakes in numerical question where you had a problem while solving. Can refer to the summary given under chapter in module. Take short breaks in between revision to refresh the mind and body. Revise the new points and type of question from the recent FTPs and MTPs. So these are some of the things which you can do. Do's and do nots. Every time I told that you have to use the reading time very, very carefully. You have to find out that which question to attempt, which question not to attempt. And then writing times, you can always try to attempt the numerical question first and the theoretical question afterwards. And you can solve the easy question first and then the difficult questions. And if you're stuck somewhere, you can leave that particular question and go to some other question. The reading time should not be wasted at any point of time, and leaving any numerical question for the end also will not be a good idea. Not giving space and making the answers makey is also not good, which is unreadable for the examiner. And wasting time writing 2 pages for question of 2, 3, 4 marks is also not good. Leaving a lot of blank pages also together read. You have to cross it if you are having some of the blank pages. So these are some of the things which we thought we'll be discussing with you. Now, very quickly, as requested by you, I will discuss what are the questions we have given. So first question, which is from the topic leverage. So you can see that from this particular topic leverage, you have to prepare an income statement. Financial leverage is given, operating leverage is given, and interest is also given. So accordingly, you can calculate you can find out an income statement. I will just show you how you can do that. So financial leverage, by using the financial leverage, what you can do, you can calculate the contribution. And then sales, you can calculate, then a new contribution also you can find out. And then the income statement, earning after tax, that is 31,875. Then cost of equity, you can calculate if you take the cost of equity into consideration. That is the second question. I will come to the question first. That is this particular question. As I told you that there may be some of the questions which is from different models. So this question is from model. So number of shares to be calculated. So how you can calculate that number of shares? So beginning we have taken, these are the figures which is already given. So first we have noted down all the figures. And then when no dividend is declared, you mean the dividend is 0. So what will be the price? And when the dividend is declared, so minus the dividend, that is 123. And number of share, your earning is 9 lakh. Dividend already distributed is this much. So funds available for investment is 12 lakh 75,000. Your total investment is 15 lakh. So you need an additional amount of 2 lakh 25,000. So your number of share will be 2 lakh 25 by 123, that is 1830. Similarly, gross profit ratio you can calculate in the next question of ratio analysis. So this is the question, and you need to calculate, you need to find out various assets and liability. Just now, what question we have solved, this is almost a replica of that question. Then in the next part, this is the question of the indifference point. Again, while discussing this, you can see that we have shown that how the indifference point is to be calculated. Here, the indifference point is given. What we need to calculate? We need to calculate the rate of dividend, or what I will say, the rate of dividend on preference share. So what we have done here, you can see that just now we have applied that particular formula, this one, and then this is given to us, and this is given to us. So what we need to calculate? We need to calculate preference dividend. So accordingly, the preference dividend we have got and the rate we have also calculated, which is 6.75%. Right? And then we come to the bigger question. So first question, which is of 4 question of 5 marks each. Then the second one is this one. Second one is this one, that which alternative we should recommend and why. And so these are the various financial, figures which is given. So equity financing, debt equity mix, preference share, all these things are given. And we can see that when the debt equity mix are there in plan 2, that is the base plan. Mind you, base plan means you have to find out the EPS. How you will find the EPS? EBIT minus interest minus tax divided by number of share. And if there is preference dividend, you will reduce the preference dividend as well. Okay. Then in the next question, let me go to the next question. This is a question of budget. So various condition is given, and you need to understand the language very carefully. So then accordingly you can calculate this particular budget after understanding the language. Two very important question after that. Always we see that this one, replacement of machine, old machine is there and new machine is there. So you need to find out a decision whether it to be done or not. So accordingly, we have calculated the base of the new machine, base for depreciation of the new machine, and then we have calculated the incremental. So this approach is known as the incremental approach. Two approaches can be there. One can be the incremental approach. One can be the approach of the total approach. So we have done with the help of incremental approach. And since the incremental NPV is positive, we have decided that yes, old machine should be replaced. Next question. Just now, what type of question we have solved in case of risk analysis in capital budgeting? The same way this question is there. We need to calculate the expected net cash flow for each project, variance of each project, standard deviation of each project, coefficient of variation of each project. The way we have shown in the main lecture. So accordingly, first we have calculated the expected net cash flow. Then we have calculated the variance. Then we have calculated the total variance. Then SDs by giving a square root. Then coefficient of variance. And accordingly, we can see that that risk per rupee of net cash flow is less in project X. So project from risk point of view, project X is less risky. So accordingly, that can be taken into account. There was certain theoretical question. So this question you can keep for last when there is not much time left. Debt securitization, the basic, discuss the agency problems and agency costs, then defining the security premium notes. So these are the questions, and these are the different kind of answers we have. Right? So in brief, this was the overall session for the upcoming year May 2023 examination. Obviously, for any further question you have BoS mobile app, and always you can come back to the BoS mobile app, so that any query you have even before the examination, we can discuss that particular question and we can give you the reply immediately. And all, mind you, the study material goes through different kind of process, so the chances of error is absolutely nominal. So trust the study material, go through that. If you found any doubt in your mind, you will write to us, come back to us without listening to any of the other things. With this, from Board of Studies, I'd like to say all the best to all of you for the upcoming examination. In between, if you require any kind of help, any kind of support, you kindly write to us. Thank you very much for listening to me.